What are systemically important financial institutions, SIFIs, under Dodd-Frank? Imagine a financial system where some institutions are so large and interconnected that their failure could shake the entire economy. That's the idea behind the concept of systemically important financial institutions. After the financial crisis of 2008, lawmakers wanted to prevent a repeat of the chaos caused by the collapse of big banks. The Dodd-Frank Act, passed in 2010, created a way to identify and oversee these major players. All bank holding companies with assets of $50 billion or more automatically fall into the SIFI category. This means big commercial banks are under closer watch. But the law also allows the Financial Stability Oversight Council to find other firms that could cause problems if they fail. These include large insurance companies, hedge funds, finance firms, and even some market utilities like clearinghouses. They look at factors like how big they are, how connected they are to other firms, how much debt they carry, and how complex their operations are. Once a firm is labeled a SIFI, it faces stricter rules. The Federal Reserve oversees these institutions more closely. They need to keep higher amounts of capital ready to cover potential losses. They also have to prepare detailed plans on how to shut down safely if they get into trouble. These rules are meant to reduce the risk of failure and prevent a domino effect that could harm the entire financial system. The idea of SIFIs came from lessons learned during the 2008 crisis. When big firms fail or nearly fail, it can cause widespread damage. By identifying these firms and regulating them more tightly, the Dodd-Frank Act aims to keep the financial system stable. These firms must also submit what are called living wills. These are detailed plans showing how they could be broken up without causing chaos. In practical terms, SIFIs face more rigorous requirements for their capital and liquidity. They undergo more frequent examinations by regulators. They also need to show how they would handle a crisis. The process for designating a non-bank firm as a SIFI involves a detailed review of its size, interconnectedness, and role in the financial markets. This process helps ensure that only the firms that truly pose a risk are subject to these extra rules. In the end, the creation of the SIFI category marked a shift in how regulators think about financial stability. It's not just about protecting individual investors or consumers anymore. It's about safeguarding the entire system from the risks posed by the biggest and most interconnected firms. The goal is to build a safer, more resilient financial environment so that future shocks don't turn into full-blown crises.